All right. We might as well continue with our discussion of DCF-based valuation. Now what we're going to do is we're going to talk about how we adapt our NPV calculations to the context of startups. So relative to the standard approach, when we're valuing startups, there are going to be a few things that we're going to do a bit differently. Just like before, by the way, obviously the NPV here should be period one cash flow should be discounted by one period rather than two. So the same typo that I had on my prior slide is also found on this one. But relative to this formula, the way we implement our DCF valuations are going to be different, and primarily because of two reasons. The first is we're going to assume, or we're going to model, a life cycle of discount rates for startups. So instead of assuming a constant discount rate forever for a startup, we're going to model the idea that we expect the discount rate for a startup to fall a bit over time, because early on, when you're especially kind of an early stage startup, you're exposed to a larger amount of risk. And so we expect that over time, the risk of a startup will fall. So we'll want to model this in our valuation. And I'll talk about one simple way to do this. So in particular, we're going to model three phases of discount rates for startups. So I'll get a little bit into that. And then another difference is that instead of forecasting average future cash flows for a startup, so like, what is the expected cash flow at time 3 for a startup? Instead, we're going to focus on forecasting not average future cash flows, but average future cash flows conditional on success. Right. So just kind of like what we had done in our last lecture, where we were focusing on exit conditional on success, we're going to do a similar thing in our cash flow forecasting in this part of the topic as well. Again, some of the justification for that is related to kind of what's easier to forecast in practice for a startup. It's easier to forecast how revenues and related to that cash flows might change for a startup if things go well, because one of the sources of data that we draw on for forecasting future cash flows in the context of startups is how other startups have performed in the past. And usually our source of data for how other startups have performed, it's that we draw that information from data on companies that went public. And companies that went public, by definition, succeeded, right? So the type of data that we have access to in general usually is data on successful companies. And so, right, that can only be, by definition, helpful for us to forecast how our startup in the future might perform in the scenario where things go well and we can have a successful exit. So the way that we forecast our cash flows are going to be, again, focused more on what happens in the success case. And because of that, we need to make an adjustment to our valuation, right? Because if we're putting in expected cash flows conditional on success, well, in general, those cash flows are going to look more attractive than the cases where a startup fails. And so if we don't make adjustments to our valuation, just like that simple NPV model that we developed last lecture, where we did our exit comparables based valuation, we needed to make an adjustment by using a VC discount rate D that was larger than our R. We're going to need to make a very similar adjustment in at least one of the versions of our DCF for startups valuation in this part of the lecture. So those are going to be kind of two anchoring differences that we make use of in our valuations of startups. So let's first, again, I'll kind of approach this similar to what we had done in the first part of the lecture, which is first I'll focus on discount rates. And some of our discussion of discount rates is going to build on what we discussed last week. Some of it is going to build on what we discussed on the first part of this lecture. And then after we discuss life cycle of discount rates and how to obtain estimates of discount rates over time for a startup, then we'll discuss the cash flow forecasting, conditional, and success. And then the third thing we'll do is how we adjust our NPV formula. So we're going to do this in three steps here this evening. So let's first talk about life cycle of discount rates. So again, one thing I want to mention is, we're getting different discount rates for different points in time for a startup, but our goal is not to have a perfect model where we're like figuring out exactly how much it changes from one period to the next. We're just trying to ballpark the most important way that discount rates are expected to change for a startup, which is that we expect a startup to have gradually declining or to have declining discount rates over time as it goes from a startup that's that hasn't exited yet to a recently exited startup that's still rapid growth to a more stable and mature company. Right. And so the way that we're going to do that is we're just going to estimate 3 discount rates. A high discount rate that we think applies for a startup during what I call its venture period. So the period of time starting now, the point in time where we're valuing the startup, until its anticipated exit date, T, right? Again, where we would have some guidance on what value of T to use on the basis of which round of funding a startup is raising. So for the value of T, what we want to do is we want to refer, again, in practice, we want to refer to, remember that this document that I had provided, which gave estimates from a historical data set of VC investments, right? So if we're valuing a startup that's in a Series B, we would expect this first stage of discount rates to last 4 periods, right? Because the average Series B exits after 4 years. If it was a Series A, it would be 5 years, right? So that's what I mean by the venture period. Venture period means the period for a startup that starts now, the point in time where maybe it's raising capital, and the expected amount of time it would take for the company to exit if it eventually is able to successfully exit. And so we'll have one discount rate during this phase. And then we'll have a second phase, which is usually when a startup exits, it's still a rapid growth company, right? So think of companies that recently IPO'd. We expect them to be high growth for a few years after the company goes public. We also expect those companies to be riskier than more stable and mature companies, right? So we have this most risky period, the venture period, and then discount rate will fall a little bit to another level during this rapid growth post-exit period. We'll assume the post-exit rapid growth period, starts after time t. So it first applies between time t and t plus 1, and it lasts until time t plus s. And then we'll assume that after this rapid growth period ends, the company has matured, has more stable growth prospects, and kind of reaches more of an industry average discount rate that's then likely to stay stable over time. So once a company enters a stable growth phase, in some sense, valuing the company at that point in time would be very similar to how we valued a company at the beginning of this lecture, because starting this point here, then you expect a constant discount rate forever. So we have these 3 phases of discount rates that we're going to try to model for a startup. And first thing I want to do is just discuss, well, how we can get estimates of the discount rate in each of these phases. So to get discount rate during the stable growth phase, we can just do what we did in the first part of this lecture, right? So how we, for instance, for Barton Mogul, got a discount rate for Amazon and Barnes and Noble, what we would do here is we would find stable comparables for our company. So what I mean by a stable comparable is we would look, well, what industry is our startup in? Let's look at publicly traded companies in the industry that our startup is in, and either take the average weighted average cost of capital of all companies in that industry, or we could even go to a subset of companies in that industry, which is the, what is the average weighted cost of capital for the average mature company in that industry. So we'd look at all publicly traded companies in the industry, separate them into mature companies versus those that are still rapid growth, and only calculate the WACC of the stable growth companies. So you see both of those things done in practice. But the point that I want to make here is to get our third phase of discount rate, we do very similar calculations to what we did in the first part of this lecture, but we do it using, as I said, mature comparables. By the way, I have a link to a website by an NYU professor called Aswath Damodaran in my slide. So if you go to this slide that says data industry WACCs for public companies for stable growth discount rates, this is just estimates that are updated on an annual basis by a finance professor at NYU that can give you a sense of what a stable growth WACC industry by industry might look like in the real world. So you can either build your own estimate for stable growth discount rates by picking your own set of mature comparables, or in practice, another thing you can do is use, again, a respectable source of these WACC estimates in public domain, like this link by Damodaran. So so if you just kind of click on this, you'll see, for instance, the average publicly traded company in the auto parts industry has a weighted average cost of capital. Oh, sorry, I can't. Just need to this a little bit. Has a weighted average. I don't remember which. 46. As of January 2020, had a cost of capital of a weighted average cost of capital of 6.37%. So this is actually a useful. Damodaran provides a lot of useful data that can be used for doing these real world discount rate calculations. But that's again, so two ways that we can get the stable growth. We use something like a Damodaran as a source of our estimate, or we can build our own, where we choose our own set of comparables that we want to use to get this stable growth discount rate. But keep in mind that you don't want to pick companies that are comparable to your startup right now. As we discussed in last week's lecture, we wouldn't be able to find a comparable like that anyway. What we want to find is companies that would be similar to our company when our company stabilizes, which, notice, is not the same thing as an exit comparable. An exit comparable would be a similar company to us at time T if things go well. Now we're looking for similar company to us at time T plus S, right, once we stabilize. So these are mature comparables, not exit comparables. Let's keep in mind that those two things are not the same. But that's how we would get this discount rate. In order to get our discount rate from time 0 to time T, I recommend just using the estimates that we presented last lecture. Remember, one of the things that we estimated from the data set on VC investments was what the average rate of return and this average rate of return, this R, is the average rate of return over the life of an investment. So the average seed stage VC investment from time 0 until exit generated a return of 16.3% per year. Whereas the average Series C investment from time 0 until exit, this would tend to be a 6-year investment. An average Series C would tend to be a 3-year, would be on average a 3-year investment. and would generate over those 3 years an average rate of return of 13.1%. So I actually just recommend as your discount rate in the venture period phase for a startup, just use the R's that we get from this historical data set. I remember, one person, I think it was either the first or the second lecture, had asked us if we could just use the average rate of return on a VC index as a discount rate for investment in VC. This is closely related to the suggestion. The only thing is I say, let's not use the average VC investment. Let's kind of try to match to whether, to what round of investment our startup is at, so that we make a distinction between a seed stage investment, which has a systematically higher average rate of return than a Series C, right? 16.3 versus 13.1. What was proposed by a student in either the first or second lecture was to take the average VC investment. Average VC investment generates about 14.5%, I think. So by matching to round of investment using this data right here, you can get a more refined estimate of a venture period discount rate. But one thing you'll notice is that even though I'm using a different R depending on whether my company is a seed stage or a Series A or a Series B, so on and so forth, I'm using the same R once I match on investment round across every industry. So it doesn't matter if a startup is in consumer internet or is in enterprise SaaS, I would use the same R if they're raising the same round of investment. So I would use the same R for those two, industries, regardless of whether, so long as they're, both raising, say, a Series B. You'll notice that that's actually quite different from what we did with our weighted average cost of capital calculation in the first part of this lecture, where we literally estimated company-specific betas, right? Market betas, right? We had a beta I that was estimated using the historical covariance between that investment's returns and the returns on the market. So we had really company-specific and certainly kind of industry-specific discount rates for mature companies, and we're not doing that during the venture period. I advocate doing this not because I believe that every single industry, once we match on round, has the same discount rate in the context of VC investments. It's just because we don't have data that allows us to go more granular than that. I've looked, I actually, one thing I did try to do with this historical data set on VC investments is I tried also separating not just by seed, by round of investment, but also by some categorization of industries. But I wasn't able to find statistically significant differences in the R's across different industries. So that's why I'm just advocating using the same R across all industries and just thinking about matching on what stage of the life cycle a startup is at. So for venture period, just again, use this source of data to pick out an R. That's the best we can do given the data that we have. This should have been part 1 of topic 2, so last week's lecture. But that's how I would get the venture period. Simplest calculation for getting our discount rate during the rapid growth period is, right, so maybe let's say we've got a seed stage investment. We'd have a 16.3% discount rate for the venture period. Let's say the industry that our startup is in is expected to have a 6.3% discount rate once the company stabilizes. Then the rapid growth period, I would just, one common calculation to do is just to take the average of the discount rate during the venture period and the discount rate during the stable growth period. So that would be the average of 16.3% and 6.3%, which would give us 11.3%. You could use that as your discount rate during this intermediate stage. And what that would be capturing is this idea that you've got the highest discount rate during the venture period. The discount rate falls a little bit during the rapid growth page, and then it falls by another equal increment during the stable growth phase, so that you go from most risky period to intermediate risk period to lowest risk period once things stabilize. So we think of that as being a sensible way to model discount rates over time. One alternative to taking the average of the venture period and stable growth discount rates during the rapid growth period would be to use a different set of comparables and to do our calculation of weighted average cost of capital off of comparables for the rapid growth phase. So instead of finding stable companies in an industry and computing their WACCs, another thing we could do is look at rapid growth comparables that are publicly traded. So for instance, within our industry, if we looked at all companies in that industry that went public over the last 5 years and estimated their WACCs using their historical return data, using those comparables, calculating the WACCs of all of those comps and averaging that would give us our discount rate during the rapid growth phase. So for rapid growth phase, the two most common ways to get our rapid growth discount rate is to either take, again, one, which is easier, take the average of venture period and stable growth period discount rate. The other alternative is use a different set of comparables than what you did for stable growth, which is specifically look at the comparables of companies in your industry that recently went public. When again, I would define recently as over the last 5 years. And then mature companies would be, companies that went public, more than 5 years ago, for instance. So those are the two ways you can get this intermediate period or rapid growth period discount rate. Any questions about this? One thing I will mention is you'll notice I've got 3 phases in this discount rates. And in our first lecture, we talked about the 3 phases of the startup life cycle. I should point out the 3 phases from the startup life cycle in our first lecture and the 3 phases here are different things. They don't coincide with each other, right? Remember 3 phases before were search for product market fit, search for go-to-market fit, and aggressive scaling. All of those 3 phases are actually happening within this block, the venture period. Maybe some of aggressive scaling continues to happen, obviously, after a company exits. But, maybe, if this is a very early stage startup, maybe search for product market fit would happen from here to here, search for go-to-market fit all the way up to here, and then rapid growth phase would start, aggressive scaling stage would start kind of here onwards. Right. So I want us to keep in mind that, 3 phases here aren't exactly matching up with the 3 phases that we discussed earlier at the beginning of the course. Now, the R that we're using from the venture period rate that comes from this data, this is essentially kind of for a seed stage, this is giving us a discount rate of an average of search for product market fit, search for go-to-market fit, and aggressive scaling, right? So it's telling us that across those 3 phases of the startup life cycle before a company exits, the average rate of return over that time is 16.3%. What that actually means is in the first couple of years, it's greater than 16.3% because of the extra risk you're exposed to. Then it falls a little bit, over the next phase, and then it falls a little bit over the next phase. So even within this phase, we expect discount rates to be gradually falling over time as you navigate successfully, search for product market fit, search for go-to-market fit, and various levels of aggressive scaling. These numbers here are meant to kind of take a blended average of all of those sub-phases. And again, the reason why I get this R that blends the whole average as opposed to trying to separate out what would be your R during a a further decomposition of these phases for the 3 phases of the startup lifecycle is that I just don't have a way to further separate discount rates during those 3 sub phases, which were the phases that we discussed in the first lecture of this course. So just keep in mind, 3 phases here don't mean the same as the 3 phases that we discussed earlier. I'm not further separating the phases within venture period because I have an estimate of the average across all those phases from this historical VC data. Maybe another thing I should mention, right? So in addition to estimating the levels of each of our discount rate levels in each of the 3 phases, we need to estimate the length of this phase and the length of this phase. As I said already, length of this phase, we can just, again, use our historical VC data. So if we're valuing a seed stage investment, I would assume that the length of the venture period would be 6 years. If it was a Series C, I would assume 3 years. Next question to ask is, well, what's the expected length of the rapid post-exit growth phase, right? So after a startup exits, how long does it continue to be rapid growth? Typical guidance on the length of the rapid growth phase, which is this parameter S, is between 3 to 7 years, with by far the most common number that I've seen used for length of rapid growth phase being 5 years. One justification for that is if we look at companies post-IPO, what I have here is, again, this is a figure that actually shows you results from real world data. This figure here shows us the growth trajectory of companies post their IPO. So in the first year after their IPO, so x-axis here is years since IPO. The y-axis is the growth rate of the company that had their IPO relative to the industry average for their industry. So we can see 1 year after IPO, the average, the median company that went public is growing about 15% faster than its industry in terms of revenue growth. Then that number goes down to a bit under 10% after 2 years. It's a little bit lower than 5% after 3 years. And we can see after 5 years, the median company is growing no faster than the average company in the industry. So this is just, again, showing you real world data that justifies the common use of 5 years as a length of rapid growth phase. If you look across industries, the length of rapid growth periods for an industry, they basically almost entirely range between 3 to 7 years. So that's why we see this range too. So modeling a rapid growth period less than 3 years or greater than 7 years would be a highly unusual decision. So use 3 to 7 years as your guide, with the most common number to use being 5 years. All right, so now what I'll do is I'll go and actually estimate this life cycle of discount rates using a specific example with a startup that's entering the virus screening software market called Secure Tech. So I'll assume this company is raising a Series A funding round. Actually, I just want to check one thing. I think I might have actually done my example with a Series B. So I just want to, I might have a typo here. Oh no, actually it is a Series A. So, so things will be okay here. Yeah, I just couldn't remember whether this was a Series A or a Series B company. So it is indeed a Series A. I'm assuming it's a typical Series A, so that I can, when I say typical Series A, what I basically mean is I feel comfortable using the Series A numbers for this startup. If this was a company raising a Series A, but I thought it was more mature than a typical Series A. It better resembled a Series B. Then I would actually make a judgment call to use the Series B numbers instead of the Series A numbers. But we'll assume here it's a typical Series A. And we want to basically we want to get the life cycle of discount rates for this startup. So what do we think its discount rate should be from now until exit? How high should it be during the rapid growth phase? How high should it be during the stable growth phase? So in this particular case, right, what discount rate would we use during the venture period, right? Since we think it's a typical Series A, that's a straightforward exercise. We just look at this and we look at the historical data set on VC investments. And it says for a Series A, the discount rate is between 14.6 and 14.9%. I mean, we could just take the midpoint of this. So that would be 14.75%. And that would be our discount rate during the venture period. So we would take again, we could take 14.6, 14.9, 14.7, like something in this range. And we would assume that the length of the venture period would be 5 years, again, using this historical data. Right, so our venture period discount rate for SecureTech would be, let's say, 14.75% for the first 5 years or the next 5 years. Let's assume the standard, 5 years as the length of the rapid growth phase. So our rapid growth phase discount rate would be a discount rate that applies from year 6 until 10. Before I get that discount rate, I'm going to go and get the discount rate for the stable growth phase. Again, if we take the approach where we get our rapid growth phase as the average of our discount rate for the venture period and stable growth period, then by definition, we're not able to get this number until we have both this number and this number. So we have this one, 14.75%. Let's go and get an estimate of a stable growth discount rate for SecureTech. So in order to do this, we need to find mature comparables for SecureTech, right? Which is companies that are mature and that are in the same industry as SecureTech. So one way to try to identify those mature comparables is we can look at the established players in the virus screening market. So what I have here is basically data on the 5 largest players in the virus screening software market. So you've got Symantec, McAfee, Trend Micro, IBM, and EMC. And so for each of these 5 companies, I would get the historical data on their returns, both on their equity and on any publicly traded debt that they have. I would also get the historical returns. Again, when I say historical, maybe I would take 5 years monthly data. Do the same thing for our proxy of the market portfolio, so the S&P 500. And I would compute for the equity, right, historical covariance of each company's equity with the return on the S&P 500. Do the same thing for their debt. And that would give me estimates of the equity beta and the debt beta for all 5 companies. I also have the debt to value ratio for each of the 5 companies as well. So Symantec is 20% debt, and that's 80% equity. McAfee, 20% debt, 80% equity, so on and so forth. IBM, 30%. And so next I want to kind of decide how to use this data along with information on the riskless rate. So I'll assume a riskless rate of 4% per year. Obviously, the current riskless rate is substantially lower than that, close to 0. Market risk premium, I'll assume for the purposes of our calculations here, of 6% per year. And both in our calculations here and later cash flow forecasts, I'll assume a 30% corporate tax rate. for each company. So given this information, how can I use this data to get a discount rate for secure tech in the stable growth phase? So the first thing I need to do is I need to decide which of these companies' data I'll actually use as a mature comparable. The first thing I want us to recognize is that we should not use the data on IBM and EMC to get our discount rate for a virus screening software company. The reason is IBM and EMC, even though they're some of the largest players in the virus screening software market, they're large conglomerates that do a lot of other things as well. So they're not kind of like purely focused or mostly focused on the virus screening software market. And so that means when we get the weighted average cost of capital of IBM or EMC, that weighted average cost of capital does not solely reflect risk in the virus screening software market. It also picks up risk in some of the other lines of business that IBM and EMC are more prominent in. And so their discount rate information is not really that informative about the risk relevant specifically in the virus screening market. And since secure tech is entering specifically that market, we ideally only want to focus on companies that are mostly focused on this market. And so the three companies that satisfy this criterion in this particular case are Symantec, McAfee, and Trend Micro. So again, first lesson to get out of this is, you may want to be careful when you select your mature comparables. Don't include large conglomerates that participate in a large number of other industries that are not related to your own product. So you want to, if you can, you want to focus on publicly traded pure plays in your industry or close to pure plays. So these three companies kind of fit that bill. So Symantec, McAfee, and Trend Micro. So all we're going to do now is given that we've decided these are the three companies that we'll use as mature company comparables for SecureTech, because these three are mature companies. They were companies that had all gone public at least 5 years before this valuation gets done. McAfee, by the way, has since been, I think, acquired by Intel, so it's no longer a standalone public company, but when this problem was designed, it was. So what we'll do is we'll calculate the WACC of each of these three companies, Symantec, McAfee, and Trend Micro, and we'll just take an average of their WACCs. So let's go ahead and do that. This calculation is basically identical to the calculation that we did with Amazon and Barnes and Noble before the break. So I'm just going to very quickly run through this calculation. So this is just kind of showing us the data that we're given in the problem, right? Sorry, just give me 1 second here. Okay, so the numbers in the spreadsheet don't perfectly coincide with the numbers in this table. So I've got 20, 20, 20. And meanwhile, in my spreadsheet, I have 20, 10, and 15. So I'll just adjust this to the numbers that we have in the slide. So 20, 20, 20. Right. I think I just neglected to make the required changes to the D over V to these companies when I was typing up the numbers for my slides in the table. But if it was 20, 20, 20, debt betas of 0.1, 0, and 0.1 respectively, equity betas of 1.5, 1.4, and 1.35. Given these D over Vs, these are the E over Vs. I think I stated in the problem the tax rate was 30%. I've done both the calculations for approach 1 and approach 2 here, but I'll only discuss them for approach 1, where we calculate the WACC of all three companies, so Symantec, McAfee, and Trend Micro separately. and then average out their WACC. So step one, we get the cost of debt for each company, right? So it's again, it's just CAPM. So 4%, the riskless rate, plus beta of debt times market premium. So 4.6%, 4% because there's a 0 beta of debt for McAfee, and beta of debt of 0.1 for Trend Micro, which also gives us 4.6%. Then we get the cost of equity for Symantec, right? We just take the 4%. Notice we use the 4% riskless rate and the 6% market premium for every single security that we're doing this calculation for. So for both the debt and the equity across every company, right? So the only thing that's changing every time we apply the CAPM is the betas that we're using. So equity beta of 1.5, that gives us 13%. Similarly for McAfee, 12.4% and 12.1% for Trend Micro. That gives us costs of weighted average cost of capital of, for instance, for Symantec, right? Remember, what do? We take D over V times pre-tax cost of debt times 1 minus tax rate plus 80% of the company is this, cost of equity of 13%. So when we balance that out, that gives us a discount rate for the company as a whole of a shade over 11%. Similarly with McAfee, we get about 10.5% and about 10.3% with Trend Micro. I also did the calculations for IBM and EMC, but as you'll see here, I only took the average of these 3 companies to get my discount rate, because these were 3 companies that are almost entirely focused on on virus screening software, whereas these other 2 companies, it's tough to interpret what their discount rate means, because it's not, they participate in many different lines of businesses. And actually, if anything, virus screening is a tiny sliver of both of these businesses. So that gives us a discount rate of 10.6%. Again, the spreadsheet I posted online is slightly different because I had entered the data with different D over Vs for each of these 3 companies. But in my slides, I made 20%. So I'm just I'm just changing the numbers in this case here. So let's just go with this 10.6%. 10.6%. And so what does the 10.6% mean? It means that, right, starting in the stable growth phase, we expect a 10.6% discount rate. So we had 14.75 goes down to 10.6% starting in the stable growth phase. So what is it in between those 2 phases in the rapid growth phase? It's the average of the 14.75% and the 10.6%. So average of, let me just go and calculate that. 14.75% and 10.616%. So our rapid growth phase discount rate would be about 12.7%. Right? And that phase, I'm assuming, lasts for 5 periods. So from time 0 to time 5, we'd have a 14.75% discount rate. From time 5 until time 10, we would have I think it was 12.7% discount rate. And from time 10 and beyond, we would have a 10.6% discount rate. So that would be our estimate of how the discount rates for this startup are changing over time, right? They're starting at a highest number and then in two rounds kind of subsequently falling discount rates. So that's how I would get the discount rates for Secure Tech over time, right? And notice it's different from what we had with a mature company because we spent some time thinking about how that discount rate might be changing over time. And this is important to consider in the context of a startup because there's a meaningful decline in the discount rate of a startup over time. If you assumed that the discount rate for the startup would be always the 10.6%, then you would inevitably overvalue the startup because you'd be applying too low of a discount rate early on in the life of the startup. All right, so that basically kind of summarizes the life cycle of discount rates for a startup, right? So we basically do the same calculation as we would do for a mature company, but using mature comparables for the stable growth period. For the venture period, as I said, we use just summary data from a large sample of historical VC investments because it's the best we can do. We can't get direct comparables for a startup in the venture period because those companies, you don't have venture period, like you don't have comparables to startups in the venture period that are publicly traded almost ever. So we basically use this other source of data because that's the best source of data we have for getting the discount rate here. And here we just kind of take it, and again, as a reasonable first pass, we can just take the average of this rate and this rate to get the intermediate stage. And that's our life cycle discount rates, kind of reflecting how much, how the risk of a startup falls gradually over time. So now what I want to do is I want to talk about forecasting cash flows for a startup. And the way we're going to do this is we're going to basically break our cash flow forecasting exercise into two steps. The first thing we're going to do is we're going to focus on forecasting revenues for the startup. And we're going to focus on forecasting revenues using a top-down approach. So what I mean by a top-down approach is we're going to start with third-party estimates of the overall size of the market that we're entering. So for instance, estimates of the future size of the virus screening software market. And then we're separately going to forecast how the market share of our company is expected to change over time. But rather than forecasting market share for our company on average in the future, we'll focus on trying to forecast what our market share might evolve like if our startup, so if SecureTech is successful, so if things continue to go well for SecureTech. So we're going to be estimating first future revenues, but conditional on success. So this highlights how we're going to be conditioning on success. So step one, we're going to forecast future revenues conditional on success. And then as a function of our future revenues, we'll forecast the other components of the cash flow equation, namely EBITDA, capital expenditures, depreciation, working capital, so on and so forth. And I'll talk about the approach that we typically use to do that in practice. So let's first talk about revenue forecasting conditional on success, right? So revenue at time t is going to be the size of the market. Where I say size of the market, I mean what's the total revenues in this market. So what are the total revenues of companies in the virus screening software market? And what we'll do is we'll get our estimate of revenue by multiplying this, a third-party forecast of market size with a forecast that we develop ourselves of what our market share will be at time t if we're successful. So if things continue to go well for our company. Now, the reason why we focus on conditional on success is because it gives us some basis for thinking about what our market share, how our market share might evolve over time from real world data. So in particular, there's two common models that are used for forecasting market share dynamics conditional on success. Both of these approaches have as a key parameter in the model something called SLT, which is an estimate of long-term market share for our startup if things go well. Why is this a useful input to try to estimate in practice? It's because we can look at the current state of the market we're entering, look at successful companies in that market, see what their market share looks like. And one sensible assumption to make is that if our company is successful, right, we would expect that we would have a similar market share to those companies in the future, given that they're examples of successful companies in the market. Again, that's an assumption, but that's a common assumption that's made when undertaking these types of valuations, right? So in order to be able to forecast market share acquisition over time, conditional on success, the first thing we do is we look at the established players in the market. Again, let's go back to thinking about Symantec, McAfee, Trend Micro, IBM, and EMC. We could look at what their market shares look like as well. So if you look at this market, right, these 5 players, Symantec has 26% of the market, McAfee has 13% of the market, Trend Micro has 9% of the market, and then IBM and EMC have 6 and 5% of the market, respectively. So the question is, how would we want to use this data on market shares to try to estimate a plausible estimate of what the market share of our startup might be if things go well? So as a general rule of thumb, I wouldn't include IBM and EMC in my target market share because, again, as I said before, IBM and EMC are not like particularly vested in this market. They're the virus, like their product that they sell in the virus screening market, really represents just a very small segment of their business. They don't aggressively market those products. And so I would expect a startup that has all of its business in this industry to be more aggressive in trying to capture market share. And that might explain why the pure plays in the market have systematically higher market share than IBM and EMC. So when I'm trying to estimate what the expected future market share of secure tech would be in this market, I would probably only focus on the market shares of the pure plays. In this particular case here, we actually see that there's a pretty substantial variation in market shares across the pure plays in the market. When I see something like that, I also find it useful not just to look at current market shares, but to look at historical market shares. And if we look at this specific market, Symantec has been really steadily over time the leader in this market at between 25 and low 30s percent market share in this market for many, many years. And we've had some turnover between, like, with other kind of new entrants in the market, McAfee, Trend Micro, there were some other entrants in the market previously. And so when a new startup enters the market, it seems like it doesn't displace market share from Symantec, but they tend to kind of substitute out amongst the pure plays, the other main pure plays in the market, like a McAfee and a Trend Micro. And so because of that, I personally would probably take a long-term market share conditional on success for secure tech to be more likely to resemble market shares for McAfee and Trend Micro, and less likely to look like Symantec, because even if secure tech succeeds entering in this market, historical evidence, again, as I said, it's not shown in this slide here, but if you look at the history of the virus screening market, you don't tend to, Symantec hasn't been displaced by new entrants. It's really been the other main players. So because of that, I would maybe for this market use 11% as my long-term market share, conditional on success for secure tech. So long-term market share conditional on success of 11%. Now, of course, secure tech doesn't have 11% of the market yet. They have substantially less than that. So now the question becomes, well, what would we expect? How would we expect the market share of secure tech to change over time? Let's see. Did I give any information on their current revenue in this exercise? Current earnings of secure tech are $2 million, whereas the overall market is $10 billion. So obviously right now they have just a tiny sliver of the market. Right, so current market share. What I'm doing right now is I'm going to present a couple of models for forecasting market share dynamics for secure tech over time, conditional on success. And so key inputs, long-term market share conditional on success. I'm taking it in this specific example off of current markets, current companies in the market, by using, I think it was McAfee and Trend Micro as my representative outcomes of market share if I succeed. Take the average of that. But essentially, I'm using comparables to get an assessment of what the long-term market share is. I'll also calculate the current market share, because for a startup, I can do that. I just look at what its most recent revenue is, compare that to the recent revenue in the market. So this is 2 million divided by 10 billion, which is 10,000 million. This is a tiny number. I might have one too many zeros or something, but I think this is right. So this would be the current market share. So the two commonly used models for forecasting out market share dynamics, one is called the L curve. L curve, pretty straightforward. It says market share ST, just means market share at time t as a function of t. By definition, at time 0, it's equal to S0. And then we've got our estimate of the long-term market share. I'll assume that the company reaches its long-term market share when it stabilizes. It stabilizes at time t plus s, where t is the length of the venture period, 5 years in this case, and then 5 years for the length of the rapid growth phase. These are just, I had assumed for secure tech. And with an L curve, L just stands for linear. We just assume that we gradually go from our current market share S0 all the way up to our long-term market share at time t plus s, and then we just plateau at that level. Right, so in this case here, it would be 11% after 10 years. And it's starting at roughly 0%, so 0.002, 0002. So approximately this is an 11% increase over 10 years, which is about a 1.1% increase every single year. The general formula for what ST would be after T periods in this L curve would just be ST equals S0 plus just a linear function times T for T less than or equal to T plus S. For T greater than T plus S, ST is just equal to SLT because we've plateaued. So this is the L curve. This is one way to estimate market share dynamics. And again, this is obtained by looking at current market shares in the startups industry. i.e. market shares of incumbents in market that are successful plus focused, usually is what we would focus on. Right, so in this particular case, we took Trend, Micro, and McAfee, and we made a judgment call to remove. Symantec, where I provided a justification for why we would not view Symantec as a realistic potential outcome for secure tech, just because it seems to be the dominant player in the market, and that there's no evidence of that changing anytime soon. So this is one approach that we can use for getting our market shares over time. And that's given by equation 11 in the slides. An alternative formula for forecasting market shares is something called an S-curve. So an S-curve.
Professor, we can't see what you're writing.
Oh, I'm sorry about that. You've not been able to see it at all, or you were able to see when I did the L-curve?
We saw the L-curve.
Okay, you saw the L-curve. So, sorry about that. All I did is I copy-pasted my numbers from before. We also had T equal to 5, S, just to avoid confusion. This S is length of rapid growth phase, whereas these S's here are market share. So I can be a bit confusing, but they mean different things. So with an S-curve, we use the same inputs, but we have a kind of a messier formula. Let me just show you the formula from my slide. So this is the formula for market share, little st, as a function of time and our parameters SLT, S0, and T. Actually, notice that this parameter is actually not used in S-curve. I won't go and discuss exactly why the S-curve has this specific formula, but what I'll do is I'll show you what this formula actually visually gives you. So when you use an S-curve, as shown in the slides, the relationship you get visually between time and market share, acquisition, conditional, and success, just like before, your market share at time 0 is by definition equal to S0. Then you still have a long-term market share. But with an S-curve, what happens is, rather than having a linear market share acquisition, with an S-curve, you have a market share acquisition that is initially convex. So the rate at which you're acquiring market share is increasing over time until you reach your exit date T, and then your rate of market share acquisition starts to decline. And it eventually converges to the long-term market share. So this is what your market share dynamics look like with an S-curve. So relative to an L-curve, right? L-curve is simpler. It's just, equal increments of market share over time until your stable growth phase, in which case you just have a constant market share thereafter. Whereas with an S curve, you have an increasing rate of market share acquisition over time until your exit date, where you have the steepest rate of market share acquisition. And then you gradually have declining market share acquisition until you eventually converge to your long-term market share. An S curve is often used by practitioners, and one of the justifications for using an S curve instead of an L curve is that it reflects, the idea of crossing the chasm that we discussed in our first lecture, which was, the difficulty of market share acquisition. So achieving go-to-market fit for a startup is that usually you struggle getting traction, and that's modeled by having a low rate of market share acquisition. But once you successfully achieve go-to-market fit, then you start growing more aggressively. So you have an increased rate of market share acquisition, but eventually you can't do that forever, and your aggressive scaling starts to subside, and eventually you just become a stable growth company. So that's kind of the logical justification for using an S curve rather than an L curve. Again, just to reemphasize, in both cases you're using the same parameters SLT, S0, and T. In the L curve, you're also using the parameter S, which was the length of the rapid growth phase. But given those parameters, you have like a fully defined set of market share dynamics. And let's also emphasize the reason why I'm calling this market share dynamics conditional on success is because the way we got our long-term market share was by looking at successful, stable companies in our industry. So assuming that we'll reach in the long term this successful market share is essentially conditioning on success. So this is not, the average market share that we expect in the future. So we don't expect an 11% market share on average. We expect an 11% market share on average when things go well. If we fail, we expect eventually a 0% market share because we're no longer operating. Can folks hear me?
Yeah, we can hear you.
Okay. Yeah.
Okay, sorry, because I just saw someone mentioning that you couldn't hear me. Was there like a long stretch of time where you couldn't hear me, or were things?
No. It was a short time.
Okay. So anyway, if you have any questions, don't hesitate as well. If you notice that I'm not seeing your question in the group chat right away, you can just unmute yourself and just ask the question, because sometimes I neglect to check what's being mentioned in the group chat. I also see Jonathan has a question. By looking at current market shares of comparable companies, don't we ignore the fact that yours will take market share away from them? So that's a good question, Jonathan. So I'm effectively assuming that if Secure Tech succeeds, effectively it's going to displace one of the existing companies. So I think, Jonathan, your question is like, let's kind of simplify it a little bit. Let's say there was just like 2 companies in the industry. What you're saying is, well, if Secure Tech succeeds, now there's going to be 3 companies, so they can't have 50% each on average. It would have to have 33% each.
Exactly.
Yeah. So So effectively, in my calculations here, one way to think about it is if Secure Tech succeeds, it'll displace one of these companies, right? And we don't think it's possible that it'll displace Symantec, but we think it's possible that it replaces either Trend Micro or McAfee. But that's an assumption. So your point is well taken that, in some markets, as more companies succeed, the market becomes more and more, has a larger number of participants. And as a result, it becomes a more dispersed industry. If you think your industry will kind of follow that trend, then we'd want to incorporate your idea. So maybe what we would say is, well, what will happen is this 22% that's shared between shared between McAfee and Trend Micro would now be shared by 3 companies. And so we would take this number and divide by 3 instead of 2, basically saying that like SecureTech comes in, they take some of the Trend Micro McAfee pie, but they don't fully replace one of the companies. So that's actually an explicit judgment call that you want to make, right? Do you think the market will become more dispersed as new players succeed, right? So that's something where looking at the history of the market can be helpful. Yes, Juan Carlos.
Yeah, so since you're modeling the S curve, would it be possible also to model the decline of predicting who are going to be the laggards in the end of it?
Pardon me? Sorry.
Yeah.
So actually, I mean, in some sense, the S curve is kind of trying to pick up some of this distribution of who's an early adopter versus who's the early majority versus the late majority versus the laggards. In fact, I mean, if you look at my slides.
Because
right?
initially it was a bell-shaped curve, right? When we saw that crossing the chasm.
Exactly. Yeah. So the distribution. Exactly. It's like the this is kind of like the distinction between a PDF and a CDF, right? So the distribution that I showed that looked like a bell curve was like the PDF, and this is like the cumulative distribution, because once you acquire the early adopters, you keep the early adopters, and then you start incrementally acquiring the early majority. That's the biggest chunk of the market, which is why you're starting to acquire market share more rapidly. Mm-hmm. And then as you start getting to kind of the later stage of the market, like the laggards, because again, the bell curve was that there wasn't that many of them, you start acquiring market share more slowly.
Gotcha. Okay.
But yeah, this is kind of like the integral of the bell curve.
Okay, thanks.
But yeah, just to wrap up Jonathan's question, your point is completely well taken. Now the only thing I'll add to this is if you believe your view instead of the view that I effectively assumed in my calculation, you can still use both of these curves. You just would be calculating your value for SLT in a different way. So instead of getting SLT as the average of 13 and 9%, maybe I would take, as I said, 13% plus 9% and divide it by 3, because now it would be split 3 ways instead of 2 ways, right? So that's really just a question of how you use existing market share data. What I will say is, especially for technology companies tend to operate more by displacement than by kind of spreading market share more thinly. So I think for especially technology startups, generally we wouldn't necessarily incorporate the factor that you mentioned. But again, you're absolutely right that like that's an explicit assumption that's being made as opposed to like a theoretical fact. So again, if you think a company is going to become more dispersed over time, then you might want to model it exactly as you suggest. All right, so now what I want to do is I want to talk about how we can go, right? So what we've discussed so far is we can use either an L curve or an S curve to forecast market share, conditional, and success. If we, in addition to that, have estimates of market size over time, we can just take the product of those two numbers to get revenues for our company, conditional, and success. So let's just go ahead and wrap up this set of forecasting for SecureTech, right? So as I said, we got a long-term market share for SecureTech, conditional, and success, given the assumptions that I mentioned, which is that Symantec won't be displaced by SecureTech, but McAfee and Trend Micro could be. So we had an 11% market share. We're going to assume third-party estimates of the overall market size for the virus screening market. Market is currently $10 billion per year. and we'll assume that professional forecasts by consultancies estimate that this market is going to grow by 7% per year over the next 5 years, 5% per year during the 5 years thereafter, and 3% per year in perpetuity afterwards. So what I have in my slides is estimates given this data of both the overall market size for the virus screening market. I have that in this part of my spreadsheet for exercise 2 part 2, right? So 10 billion market size right now, growing at 7% per year until time 5. And then at time 6, up to 10, it's growing at 10% per year. I could also say, time 11 and beyond. Right, time 11 and beyond, growing at, I think it was 3%, say. Right, so this is our market size forecast over time. In addition to that, as I said, long-term market share of 11% conditional on success. Our current market share was 2 million over 10 billion, so 0.0002. 5-year length of venture period, 5-year length of rapid growth phase. So given those numbers, I just, in this spreadsheet, have incorporated both the formula for an L curve and an S curve. And so this gives us L curve market share acquisition. This is our market share acquisition using an S curve. So obviously, we'll get different forecasts of revenue and cash flows in depending on whether we use an L curve and an S curve. So you get different valuations, for instance, for secure tech under both cases. But visually, this is the market share dynamics with an S curve versus an L curve. And then for the L curve from this point on, it's just constant at 11%. And it's extremely close to 11% once we get to time 10 with the S curve. Right, so 10.98%, for instance, here versus 11%. This number here would converge over time to 11%. But so if we take these market share estimates and multiply by market size estimate, this is our estimate of revenues for secure tech under an L curve market share acquisition forecast versus an S curve market share forecast. But this is the first thing you want to do when you're forecasting cash flows using a top-down approach for a startup. Just remember, you're going to be estimating things when you use successful companies to get your long-term market share. You're estimating things conditional on success. And then what we're going to want to do next is basically estimate our the rest of our cash flow components conditional on success given these revenue forecasts. So how do we do that? So next thing is, how do we go from this top-down forecast of revenues conditional on success to estimating all of the components necessary for getting the cash flows of a startup, right? Because at the end of the day, we want the cash flows of the startup so that we can combine that with our discount rate to get an estimate of the value of the startup. And so the way that we typically do that is we use a forecasted relationship between revenues and the other components of cash flow. So in particular, right, if we go back to our original cash flow formula, we had cash flow equals 1 minus tax times EBITDA plus tax times depreciation minus CapEx minus change in working capital. So what we're going to want to do is get an estimate of EBITDA as a function of revenue, an estimate of depreciation as a function of revenue, an estimate of capital expenditure as a function of revenue, and an estimate of working capital as a function of revenue. And I'll just show you the standard approach that's used for going from revenue forecast to each of these other components of the cash flow equation. So the way we usually get EBITDA off of revenue is we come up with estimates of margins for a startup over time. So I'll just define my measure of margins that I'm using here as EBITDA divided by revenue. So if I take this measure of margins, multiply that by revenue, then by definition I have the EBITDA of the company. Now, generally, if you look at a startup right now, its margins early on are going to be negative. So in terms of notation, this is our estimate of current margins for a startup. Again, usually a startup early in its life has negative margins, so think of this as a negative number. Now, obviously, if we think the startup has value, it must mean that we expect its margins to eventually become positive. So let's assume that the startup has long-term margins. And when I define long-term as being its margins at time t plus s, once it stabilizes, it has this level of long-term margins. So if it starts at this level and it ends at this level, then what that means by definition is that we've got an increase in margin equal to this amount. What I'll assume in my forecasting is that the margins are going to improve gradually over time from their current number, which is, again, for a startup will typically be negative, to their long-term positive margins. And here I'm just assuming a linear relationship. So there's a constant increase in margins every year from now until the point in time where the startup stabilizes, so time t plus s. Right? So for instance, in the context of SecureTech, I'll assume its current margins are minus 14%. But I look at the comparables and the margins of these 5 companies that were the leading players in the virus screening market, IBM and EMC, 22%, 21%. But I'm not going to use their data because these basically blend an average of the margins of virus screening and all the other lines of business that IBM and EMC have. So this is not useful information, but we can see we've got margins of between 14 and 16% for all of the pure plays in this market. So maybe I would either take the average of McAfee and Trend Micro, or I would take the average of all 3 companies. That it doesn't make a material difference in our forecasts here. But I'll use these as measures of long-term margins because these are the margins of companies that are successful and stable in the market right now. So that'll give us our long-term, maybe for illustration purposes, I'll pick the average of McAfee and Trend Micro, just because I can average that out. 15% is a calculation to do in my head. So 15%. So we're going from minus 14% if things go well to plus 15% over 10 years. So that's a swing of 29%. So we have an increase in those margins of 2.9% per year. In other words, we've got margins of minus 14% right now. In a year, if things go well, we expect margins of minus, I think, 11.1%. Then a year after that, the margin would increase by another 2.9%, so on and so forth. So notice we're using the margins of established players in the market. We can get that information for at least publicly traded companies by looking at the financials of those companies. So we can actually get this data in the real world. We're looking at what our startups' margins right now are, and we're assuming that our margins are going to gradually go from current level to long-term level using this kind of linear relationship here. So this looks like an L curve, right? It's basically the same idea, but applied to margins instead of market share. So generally, we assume that for startups. What about forecasting the other components of the cash flow equation? So to forecast capital expenditures, the relationship that we generally use is that capital expenditures at time t are going to be related not to the revenue that we have at time t, but the anticipated change in revenue from time t to time t plus 1. And the reason for that is, why do you make capital expenditures? You make capital expenditures to expand production capacity, for instance. Well, what determines how much production capacity you need to expand? Well, it's how much you expect increase in revenue over the next period, right? So you could have a company that has high revenue right now, but if they expect little to no growth over the next period, they don't need to invest in capital expenditures this period. Meanwhile, you could have another company that has very little revenue right now, but if it expects a large amount of revenue growth next period, that's the company that should be investing more in capital expenditures. So that's the reason why we relate capital expenditure not to current revenue, but to anticipated next period change in revenue. Right, because it's, that goes more to the heart of why we make capital expenditures. It's to expand our production capacity. And we just assume, usually, in standard valuations, that the relationship between CapEx and next period change in revenue is constant over time. Notice that's different from what we assumed with EBITDA. So with EBITDA, we assumed changing margins over time. We do that because that's a very striking feature in the data for startups, is that they start with negative margins, and their margins gradually increase and eventually stabilize if things go well to positive level. Meanwhile, if you look at the relationship between CapEx and changes in revenue, even for startups, those stay relatively constant over time. Devanshu, did you have a question? Sorry, I can't hear you very well. Can you repeat that? Pardon me? Maybe you can type the question, because I'm having a lot of difficulty hearing you. Sorry, Devanshu, I can't hear. I'm not sure if it's a problem on my side, but I can't make out your question at all. I'm sorry. All right, I'll continue with my discussion of these parts. I'm sorry that I can't hear your question, but if you type it, or if we talk at the end of the lecture, I'll try to address your question. I'm sorry about that. Okay, so going back to our discussion, right? So yeah, so we estimate a relationship between next period anticipated change in revenue and CapEx. Usually, in terms of getting this parameter theta C in the real world, we just draw that from industry averages for publicly traded companies. Because that number doesn't tend to change a lot for startups versus more mature companies, it's actually sensible to estimate this number off of public company data, even though a startup isn't a public company yet. Again, this is just an insight that's drawn from historical data on the CapEx activity of startups. Even startups tend to have a similar relationship between anticipated next period change in revenue and CapEx as public companies. So that's why we just model a constant theta C, as opposed to modeling a changing relationship between revenue and, say, EBITDA for a startup over time. It's because this number clearly changes over time for a startup. This number seems to stay relatively constant. For depreciation of a startup, we'll take depreciation at time t to be equal to the depreciation that a startup had in its prior period, plus some percentage of its CapEx over the most recent period. This just is meant to represent the fact that we expect depreciation to increase for a startup over time, because it's got a larger and larger asset base over time to depreciate. This parameter theta d, which is the only parameter in this relationship, is just given by 1 divided by the average length of the depreciation schedule for the assets that a startup acquires when they're making capital expenditures. So if the average asset that a startup purchases has a 10-year depreciation schedule, then this theta D would just be 1 divided by 10 equals to 0.1. What this is saying is whatever you were depreciating last period, you're still depreciating this period. And in addition to that, you depreciate 10% of the new investments that you made over the last period. Final component that we'll need for getting our working capital, for getting our cash flow forecast is working capital. We usually just assume that working capital is a set percentage of revenue. And just like we did with capital expenditures, we assume that that percentage is constant over time. Empirically, it does seem to be similar for startups as it is for more mature companies. And we usually draw that off of data for companies in a similar industry to us as well. And so given that, we can go from our revenue forecasts, again, everything is conditional and success, to estimates of working capital, depreciation, capital expenditure, and EBITDA. And given those numbers, we can then combine to get our cash flow forecasts. So let's go ahead and do those calculations for the case of SecureTech. I think what I'll do is after this, I'll basically wrap things up for the evening. I'll have one more thing to discuss to kind of fully wrap up our DCF valuation for startups, which is how we go from our cash flows, conditional and success, and our life cycle discount rates to evaluation of the startup. But I'll post those in a video a little bit later this week, just because I guess we're already a little bit extended beyond the normal lecture time here. So what I'll do now is I'll just go and get our estimates of cash flows, conditional and success for SecureTech, given the numbers that we've computed so far. So what have we done so far? We've gotten our revenues, conditional and success, using both an L curve and an S curve. We've also estimated a long-term margin of 15%, conditional and success for SecureTech, using the data of McAfee and Trend Micro. We have a current margin of minus 14%. So that what I've done in column E of the spreadsheet right here is I've forecasted conditional and success what our margins will be every year, right? So if things go well, we expect on average to go from minus 14% to minus 11.1 to minus 8.2. By the time we get to time 8 plus 9.2, time 10, 15%, which then stays constant over time. Time 10 was our expected stabilization date. I've set up my spreadsheet so that if you enter 0 here, we get our market share and revenue estimates for an L curve. So you can see these numbers change. And if you put in a 1, you get the S curve. But I'll just illustrate this with the S curve right now. So we got, with an S curve, this is our market share acquisition over time on a market of this size. These were numbers that we had obtained in our previous part of the exercise. Multiply the two together, that gives us our revenue. I've defined my margins in the problem statement, not as EBITDA, but as, not as EBITDA divided by revenue, but as EBIT divided by revenue. So if I take this margin multiplied by revenue, it's giving me EBIT, earnings before interest and taxes. By the way, I'm going to be using a slightly different formula for cash flows here. I'll be using cash flow T is equal to 1 minus tax times EBIT instead of EBITDA. And then it's plus depreciation minus CapEx minus change in working capital. mathematically, this formula is identical to the formula I showed earlier. Cash flow T equals 1 minus tax times plus tax times depreciation minus CapEx. These two things are identical, so you can always use one version of the formula or another. The one you use just usually depends on how you defined your margin number here. If you define it as an EBITDA divided by revenue, use this version of the formula. If you define it as EBIT divided by revenue, then use this version of the formula. The difference between EBITDA and EBITD is that EBIT equal to EBITDA minus depreciation, right? So this is EBIT is basically after subtracting depreciation from EBITDA. Okay, but in any case, given this, I have my estimates of EBIT over time, right? All I did is I took my changing margins over time, applied it to my changing revenue forecast over time, and that gives my EBIT, my forecast of EBIT over time for Secure Tech, Conditional, and Success. Next thing I do is I get my estimate of CapEx over time, right? CapEx over time is just equal to expected next period change in revenue. So revenue at time t plus 1 minus revenue at time t times the parameter theta c. Parameter theta c is just CapEx divided by change in revenue. So I just did change in revenue divided by CapEx. So if we divide this number here, this basically just tells us that theta c is equal to 1/2. By the way, going back to our problem statement, problem statement said, on average, so for publicly traded software companies, on average, they generate an increase of $2 of revenue next period per dollar of CapEx today, right? And so that means if you want to generate $1, a $1 increase in revenue next period, you need to invest 1 divided by $2 in CapEx today. So that's why in this calculation here, I'm taking change next period revenue divided by 2, right? So it's just saying times 0.5, which is the amount of CapEx you need to make to generate a $1 increase in revenue over the next period. So that's how I obtained this column, is I just keep applying that same ratio every period, but over the next period change in revenue. So notice I just kind of defined this column formula style. That's how I obtain this. Again, I would obtain this number here by looking at data of public companies in my industry. I can apply that even for the startup early on, because this number doesn't change much for both a startup and more mature companies. I'm going to assume here that the company depreciates assets over 20 years. And so its first depreciation would be what? It's CapEx at time 0 divided by 20. So I'm just assuming straight line depreciation in this formulation. Even if depreciation isn't straight line, that's usually an assumption that's made for valuation purposes. And then every period I'm just taking prior number depreciation, because we still continue depreciating that amount for the CapEx that we had made in this period. And then I add an additional batch of CapEx from the new round of investment that was made the prior period. So that's how I obtain this column. And then the final thing I calculate is working capital, eventually I want change in working capital. So first, what I do is I compute expected working capital, conditional, and success. In this problem, so it turns out for companies in the virus screening market, or I think this is actually from software companies in general, I find that working capital equals on average for publicly traded software companies equal about 8% of revenue. So I'll apply 8% of revenue as my estimate of my working capital number. So 8% of 2 million is 160,000. 8% of about 7.5 million is about 600,000, so on and so forth. And then given that number, I can calculate my change in working capital as the difference between this period's working capital and the prior period's working capital. And then given this column, this column, this column, and this column, I can use my cash flow formula to get my cash flows. And so this gives me my estimate of cash flows over time, where I'm also using that 30% tax rate that I've assumed. So that means we're estimating for SecureTech, if things go well, we expect SecureTech to lose, well, it lost 3 million in the most recent period. So I'll assume this is sunk in my valuation later on, meaning this negative cash flow has already happened. So it shouldn't be impacting my valuation right now, which should be forward looking. But if things go well, we expect to lose 11 million next year, lose about 39 million in year 2, minus 116 million in year 3, so on and so forth until time 10, where we expect, if things go well, to generate positive cash flow of $218 million. So notice, with this startup, even when things are going well, it's expected to be losing more and more money for several years, in particular until time 5. And then it expects to be still losing money, but progressively less money over a couple of years. And then it becomes profitable starting at time 8, given these forecasts, which, by the way, is a pretty typical looking pattern for cash flows of successful startups. Again, let's keep in mind, this is conditional on success, right? So these negative cash flows are what we're expecting when things are going well. And the reason is you still have negative margins, right? For a period of time, even when things go well. It's only later on that you start having positive margins. And even while you have positive margins, if your margins are positive but relatively small, and you're still making a lot of capital expenditures, and your working capital is still increasing enough, you'll still be losing money, which is why you still have negative cash flows, even when you start hitting slightly positive margins. It isn't until your margins are positive enough that you start generating positive overall cash flows. But this is our, eventual forecast of cash flows for SecureTech, but these are cash flows conditional on success. So now what we're going to want to do is we're going to want to combine our discount rates, which were 14.75%, 10.6%, and in the rapid growth phase between this phase and this phase, 12.2%. We'll want to combine those numbers along with these cash flow forecasts to get a valuation of the company. But we don't want to just use our standard NPV formula where we just discount these cash flow numbers with these discount rates, because we need to make an adjustment for the fact that these are conditional on success, so they're not incorporating the possibility of failure. And there's 2 ways to do that, and I'll explain both of those approaches. One is going to be called DCF with VC method, which is going to be a simpler approach to using this information and this information to get a valuation, and then a more fully rigorous approach that I call fully fledged DCF. So I'll talk about 2 ways to get a valuation using these numbers and these numbers combined. And I'll, but since it's 9:15, I think I'll wrap up the lecture for tonight, and I'll add videos that discuss how to use these inputs along with these ones to get valuations using these 2 DCF, two versions of DCF